Record AI profits, a violent momentum unwind, and a fresh wave of defense and energy spending are all colliding in equities right now. This is vTalkInsight, Equity Pulse Daily for July 8, 2026. Global stock markets are calm on the surface, but under the index level we are seeing sharp sector dispersion, tighter financial conditions, and rising geopolitical risk that are reshaping both risks and opportunities across the equity landscape. The macro picture behind equities is increasingly two-sided. Headline growth remains solid, yet U.S. consumer sentiment is now described as the weakest since the 1950s, and housing affordability has deteriorated to historic lows as high mortgage rates clash with stubborn home prices. That combination helps explain why earnings and balance sheets can still look robust, while households feel squeezed and more sensitive to shocks in jobs, energy prices, or credit availability. Layered on top of that is a meaningful rise in long-dated yields. In the United States, the 30-year Treasury has pushed above 5% and the 10-year sits above 4.5%, tightening financial conditions and raising questions about how long-risk assets can absorb higher discount rates. Globally, worries about debt sustainability are building, with commentary flagging that many sovereigns could face unsustainable burdens if rates stay high, and U.S. interest payments are on track to rival or exceed defense spending. The Treasury curve has flattened as markets price a period of elevated short-term rates, but limited conviction about an extended hiking cycle. At the same time, flows into money market funds and short-term treasuries remain heavy, underscoring a strong preference for liquidity and policy optionality. In Japan, robust demand for a 30-year government bond auction near a 4% yield shows how some long-term investors are happy to lock in higher income, even as uncertainty around fiscal plans persists. Positioning and volatility add another twist. Leveraged hedge funds are reportedly the most bearish since 2007, with substantial new short exposure, while momentum baskets have suffered roughly a 24% peak-to-trough drawdown, the largest in 5 years. Index-level volatility, with the VIX hovering in the mid-teens, looks contained, yet implied volatility in sectors like semiconductors and in single stocks remains historically elevated, signaling that the real turbulence is happening beneath the surface. Inflation sits at the center of these cross-currents. Recent upside in oil and gas prices tied to strikes and attacks near the Strait of Hormuz is reviving inflation concerns, even though spot oil also shows signs of near-term oversupply and Saudi price cuts into Asia. Looking out a bit further, medium-term energy prices are still expected to drift higher, while reshoring of manufacturing and AI-driven capital expenditure are seen as structurally inflationary forces, challenging earlier hopes that artificial intelligence would quickly be a deflationary shock. Against this backdrop, the soft landing narrative from recent weeks is intact but more fragile, setting the stage for a rotation in equity leadership. Under the hood, equity leadership is no longer a simple story of a handful of mega-cap AI names. Market breadth is improving, with a growing share of S&P 500 constituents participating in gains, and the main U.S. small-cap exchange-traded fund is up around 20% year-to-date. Healthcare, industrials, and smaller companies are described as outperforming, while emerging markets that are less tied to the AI trade, particularly in Latin America, are viewed as relatively attractive on valuation grounds. This broadening has come at the expense of crowded momentum trades. Systematic momentum strategies have endured sharp drawdowns, with one prominent basket down about 24% from peak to trough, marking the most painful stretch in 5 years. Regionally, Asian markets have been whipsawed by semiconductor swings, whereas European equities look comparatively stable, with modest sector moves and most groups advancing even as technology and basic resources lag. The implication is that equity markets are moving from a regime dominated by factor beta to one where stock and sector selection matter more. With hedge funds heavily short, cash piled in money markets, and volatility clustered in specific themes, any surprise in inflation, policy, or earnings could trigger powerful squeezes. Nowhere is that tension clearer than in the AI and semiconductor complex, where record profits are running into sky-high expectations. Samsung has become the latest symbol of how unforgiving the market has become toward AI beneficiaries. The company reported a record quarter, with profits surging 19-fold year-on-year and semiconductor operating margins estimated near 80%, broadly in line with Micron Technology's recent strength. Yet the share still fell more than 10%, dragging the Kospi down over 4%, because even that performance fell short of already elevated expectations and prompted aggressive profit-taking. The shock from Samsung has rippled across global tech. Asian memory names in Taiwan and China have come under pressure. European tech and chipmakers are selling off, and European AI-related equities are seeing renewed declines even when a major sector player posts strong profit growth. Micron and other memory stocks are also under strain, reflecting investor unease about stretched valuations and doubts about how long current levels of demand can last. Fundamentally, the demand story still looks powerful. Spending on DRAM, high-bandwidth memory, NAND flash, and solid-state drives is expected to remain structurally strong as AI inference workloads and hyperscaler data centers expand. Samsung and SK hynix are planning heavy capital expenditure over the next 5 years to roughly double memory capacity, and many market participants see visibility for robust chip demand into next year. However, concerns are growing about potential oversupply and whether enterprise adoption of AI will generate enough earnings to justify this investment beyond 2025, especially if credit markets eventually tire of funding AI capex without clear profit delivery. At the same time, AI is extending far beyond chips. Usage of AI-driven therapy tools in mental health has more than doubled in a year, and companies like Spring Health are establishing open benchmarks for ethical and responsible AI therapy, signaling that regulation and standards are catching up with adoption. Demand for software developers is rising alongside the AI boom, and historical parallels suggest that new technologies tend to create at least as many jobs as they displace, even though AI-related capital expenditure is adding to inflation in the near term rather than suppressing it. Within technology, leadership is shifting from broad-based momentum to more selective dispersion, where stock picking matters, and developments such as SpaceX entering the Nasdaq 100 illustrate how index inclusion can steadily channel passive and benchmark-driven flows into newly prominent growth names. Beyond AI, defense and security are emerging as durable equity themes. NATO members are accelerating defense spending, with commitments pointing toward as much as 5% of gross domestic product by the mid-2030s, after years of pressure for burden sharing. Germany plans to lift defense and security outlays to over €200 billion by decade end and up to roughly a third of the federal budget by 2030, while Italy is set to add €17 billion over 2 years and Latvia is on track to reach 5% of GDP on defense next year. The focus is not just on bigger budgets, but on modern capabilities. NATO and European governments are prioritizing drones, advanced sensors, and especially underwater technologies to protect critical cables and pipelines in congested regions, such as the Mediterranean. Demand for unconventional underwater systems and subsea telecommunications is accelerating, and a European defense contractor winning a multi-billion-dollar submarine contract with Canada, while a South Korean rival stock dropped sharply, shows how this theme is already creating clear winners and losers in listed defense names. Energy markets sit at the intersection of geopolitics and inflation. Attacks on vessels in the Strait of Hormuz, including a Qatari liquefied natural gas carrier, have driven European gas prices up by just over 5% and nudged oil higher, while shipping activity through the choke point remains below pre-conflict levels. Iran's efforts to enforce designated maritime routes and potential transit fees are adding to supply uncertainty, even as a front-end glut and Saudi price cuts into Asia suggest near-term oversupply. Looking ahead, medium-term energy prices are still expected to rise, and Chinese buying behavior is seen as a key swing factor that could swing Brent crude between roughly $60 and $80, supporting earnings for resilient oil and gas producers, but complicating the inflation outlook for central banks. Credit and politics add further nuance to the equity backdrop. Rising rates in a heavily indebted global economy increase the risk of financial instability and raise questions about long-term debt sustainability, with France's widening spread over Germany reflecting both fiscal concerns and political uncertainty ahead of key legal decisions that could reshape Marine Le Pen's role and the broader leadership landscape. In private markets, HSBC's move to suspend lending to riskier private credit funds after some high-profile bankruptcies points to more cautious underwriting, even as broader credit markets remain comfortable funding large-scale AI-related capital expenditure for now. Company-level signals reinforce the picture of a more discriminating, stock-specific regime. Quinetics Pharma has almost doubled after Vertex announced its largest-ever acquisition, highlighting renewed appetite for biotech M&A and the potential for sharp re-ratings when strategic deals land. Millennium Management's index trading teams reportedly generated about $3.7 billion in June, contributing to a monthly return above 4% and over 10% year-to-date, underscoring how volatility and dispersion can be turned into performance by sophisticated strategies. On the consumer side, intense price competition among U.S. grocery chains such as Walmart and Kroger may compress retailer margins but supports households facing weak sentiment and low housing affordability, while stronger than expected retail sales linked to tax refunds and gasoline prices suggest spending will be highly sensitive to the next move in energy. Finally, extreme heat waves in Western Europe forcing banks to relax office attendance show that climate-related operational risks are becoming a tangible consideration for corporate planning and, by extension, equity risk assessments. Putting it all together, equities are trading in a narrow corridor between higher discount rates, fragile but still supportive growth, and powerful structural themes in AI, defense, and energy. Index-level volatility looks benign, yet the combination of bearish hedge fund positioning, a momentum crash, and elevated single-stock dispersion tells us the real story is in how leadership and valuation are being reassessed below the surface. Key signals to watch from here include the interaction between energy prices and inflation data, whether AI-related earnings and capex plans can justify current semiconductor valuations, how NATO's defense commitments translate into orders and cash flow for listed contractors, and whether emerging strains in sovereign and private credit stay contained. A market that was once driven by a narrow set of mega-cap tech names is broadening out, but doing so in a way that rewards selectivity and punishes overconfidence. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.